Hello guys, glad to have you on board again today. We will do as usual, but first I'm going to give a tiny introduction today. Of course, there was a lot of delays answering the messages you've been sending while I was on vacation, so of course I will take care of this ASAP. But you can still expect a few days to get the answers on your emails and questions you've been sending in TradingView and things like that. So don't worry, everything will get back to normal in just a few days. That was the last of my vacations. Now we're on track to just work as usual, at least until we get to end of that year, holidays, usual stuff, but I bet you guys as well will take some vacations as well on that precise timing. So we just start with the Bitcoin, and things that I have in front of me are pretty well interesting. If we get back to what I said yesterday before I left you, it was basically if when I come back we still manage to neither have broken a resistance or a support, and that we still remain in that kind of desert crossing phase, we probably will have narrowed Bollinger Bands and very low volume. This is what we have in front of us right now. So let's just be clear in what the way we should expect the market to behave in the next following weeks is exactly as expected last time, which is, now that we have it, those who don't have a single trade in Bitcoin should now have one. I think the timing is good enough to forecast the markets to be in that desert crossing phase. So you could still be right or wrong. This is, once again, nothing that we fucking care about when we do trade. You just need to limit the risk. I think right now the risk is limited enough for you to be bullish on that market. Taking a first step into bullishness doesn't say you got to put the entire amount of money you were expecting to put in that market just right now, but it is a buy and hold scenario. So if you do take that trade, obviously you need to be ready to lose it all. It means you buy the Bitcoins at 6,500 and it can just worth a zero in the end. So you're going to lose it all. That's the risk you need to face, because we are buying and holding an asset that we still don't know if it's going to worth something in the end. If it do worth something, I bet you might be able to sell it at higher pricings. Or just holding it the long term if you do still want to have Bitcoins for other reasons. But if this is just in a long-term speculative perspective, you might be able to make a gain out of that trade. So buying right now, I say, okay, I myself, I'm going to buy a few Bitcoins probably today or tomorrow. There's no rush. I mean, we're in the desert crossing phase, so you don't have to stress yourself opening an account in a rush, making weird bank transfers. Take your time. There's no rush. Yes, the market could just flush tomorrow or start to rise tomorrow, but don't stress yourself. Normally, you should have more than enough time to do what's necessary. Do it nice, do it well, enjoy that thing, and once you press the buy button, you don't want to have a look at the 2-hour charts or whatever thing this is that is short term. You're not doing anything close to short term right now, so if you do press that button, there's just one action that you need to make afterwards, is to put a damn black box, and you just don't care about anything that happens, let's say 5,400 and 8,500. Anything in between is none of your concern. Even if everybody calls you, the Bitcoins are falling apart, whatever shit this is, you just don't give a shit. You wait for something reliable to happen, meaning a daily close below 5,400, and if it happens, then you were supposed to be prepared for this. So you shouldn't panic. Your friends might be calling you saying, oh geez, I'm selling all my Bitcoins, this thing is shitty, I should never have bought it, why are you still holding them? You just say, you know what, I have a plan, I have managed my risk, you do whatever you think this is, but you're trading emotional, so you're not trading, I am trading, so fuck it. You do what you plan to do, you don't change anything in between. If it happens, you were ready to take that risk, so you don't come to cry if this thing worth $0 in 2 years from now. But if these things were to be worth something near that 17,000, 20,000, then obviously you can be there to say, okay, I was right to hold the prices, even if the Bitcoin dropped 3K and you bought 6.5. It's no big deal. All we care in here is to have a decent reward for the risk we're taking. And I think the desert crossing phase, as I said, is one of the many ways that this market can bottom up. And if we do make it, you absolutely want to profit from it. So you got two choices. Either you're buying the prices right now, or you wait for the price to go for 8,500. But obviously 8,500 is 2,000 more than the price we're currently trading on. So this is a choice you have to make. If you do want to make the breakout trade, obviously far less reward for a bigger risk. So you have to use far tinier position sizing. On the opposite side, you can take a few more Bitcoins if you do buy them right now, but obviously the risk is bigger. Because if you do buy right now, you don't know that the market is going to the upside. If you're buying 8,500, obviously you know the market is chasing back resistances, which is a pretty good sign that the market might keep on doing it. So we're waiting for this. So there's no big news to happen right now in terms of cryptocurrencies. Ethereum is basically doing the exact same thing. We could have the risk of some more downside because once again we're just exchanging the value between two different type of traders. We've had short-term traders who've been pushing the price to the downside right in here. As you can see this clearly, it happens. And then as we reached out to the support area, as the volume starts to rise, and then rise really sharply at levels we've never seen since the market went crazy bullish the last time. So it says, or at least it suggests, that the market is switching hands. The valuation is changing hands. It goes from speculators to probably other guys like me who are probably expecting to long-term buy and holding. But as this is the point, the market will reverse if it happens. And I really stand on this. If it happens, there's no certainty out there. There's just a typical price pattern suggesting the buy and holders are at play on those on this price area. Doesn't necessarily mean we cannot have a brutal bearish sharp breakdown. If we do have something like that, I hope this one is going to be brutal and rapid. I don't want this to last long like we've done in here. This is why it is still possible to happen. But if you did manage your risk like I did, you need to be ready to face this without changing anything but following the plan. So if it decides to go to the downside for any fucking reason, you just don't move. The plan is to buy and hold. If it goes down, that's part of the plan as well. The only way you can lose it is if it goes to 0 1 year from now. If 1 year ahead, we're still lower pricing that market, simply mean that we bought a dead end. And if that's the case, then we'll simply have to suffer the risk we've been taking. We take a risk for a gain, means that if we take the gain, that's nice. If we take the risk part, it happens. That's how it is. This is why you don't want to put 10 or more than 10% of your capital in here. Those who are really confident and put it 15%, that's literally the maximum you could ever consider doing. If you're putting all your money into just Ethereums or Ethereums and Bitcoins, you're just totally wrong. At least you shouldn't follow my scenario because you and I are doing totally different things. I do make a speculative buy and hold entry, nothing close to putting all my money into a few asset classes. Now, when it comes to Ripple, it's still pretty much doing what we expected it to do, meaning that it's literally dying in between. We're in kind of a black box scenario. If you put the resistance back to the market bottom and you just use the range scenario, you're right into the dumb zone. So if you do trade those prices, you're really dumb. So you don't want to be dumb. Once again, traders are making reliable, smart decisions with a risk management. We don't play gods. We're just here to limit the risks and then put a statistical advantage in our end to make sure that in the long run, we're going to get money out of the risk we're taking. That's just it. So if you're trading here, you're taking way too much risk. You're playing with 50-50 kind of scenarios. Yes, in 2 days, the ripples could just be there. They could be there as well. So if you're taking the risk, not knowing where the market is going, it's probably that the market will take the risk part of your trade, meaning it will take your stop loss and fucking get you out. So this is not what we want. As you can see, the volume is dropping back to usual standards, which means at that point, we really can confirm that the market is ranging, and you really don't want to buy right now. You don't want to sell either. You just want to let the stupid guys trade that market as long as they want. So let the market drop, let the volume drops, let the market try to make some breakouts, and you only do trade the boundaries. So if it goes up here, if you want to sell, you're free to do it. If you want to buy at the bottom, obviously you're free to do it as well. But if you do anything in between, you're just dumb trading. You don't care about any signals happening in there. All you can care of is whenever the price goes here, the daily is your context. So you go a 2-hour chart time frame and you wait for a 2-hour chart signal in or above the red area. If such thing happens, then you can fully get in here, where the risk management means you put a stop loss in here, and you should prefer buying the lows, because we are in what kind of context. Once again, apply the strategy. Step 1, 2, and 3. You don't push the button before you check those 3 steps. Step 1 is a range scenario to me, but a bullish range, because I think we're going to exit that range to the bull side as we terminated the corrective waves. So for now, it remains a range, which means you can either buy or sell. I don't really care. All I care is that if you want to stick with some positions and keep them open, you can only do this with the buy entries. So the buy entries you could make out there, you profit taking on the market tops and the middle, but you can spare some part of that trade for potential longer term scenarios. In the bear side, if you do take the selling entries, you obviously take the profit if you ever get to the down areas. Okay? That being said, there's nothing else to say. The market is just ranging in every fucking cryptocurrency. Whether it is Bitcoin, Ethereum, or Ripple. The outcome can be either bullish or bearish. You really have no clue. So all you can do here is just nothing close to speculating, but making long-term buy and hold speculation. This is all you can do. Try to play the game and speculate on the fact that others are doing it as well, that the speculators are going out of that market, and that the money is slowly transferring to long-term buy and holders. And whenever they will take the advantage, and normally they do in that kind of context, means that most of the market cap is going to be holded by a few persons, the buy and holders. And when the buy and holders will probably hold approximately 80% of the entire market cap, means just 20% is on the free available cash flow. When we reach to that tipping point, we generally have a change in the market price structure, meaning that after reducing volatility, the market will search for it again. And volatility can go to the downside and to the upside, which means we can have a first move to the downside, but normally the only one that can last and go further is the upside, which means can have some downside, can have some upside as well, but more likely to have a follow through to the upside. So it means if the market starts by the upside, probably going to have lots of buyers to follow through. If the market starts to the downside, it's probably going to flush some stop losses of stupid guys who've been putting too much leverages, and then we're going to rebound pretty easily, and then we'll find buyers following through, which means if it goes down, probably going to be a fake short-term breakout to rapidly wrong foot the bears and go on the opposite side. Okay, so that's it for the cryptocurrency sector. We're going to move out and make a complete review because we got lots of things to talk about today. As obviously, it feels like it's how the market likes to play with me. And generally, I'm waiting for this fucking thing for months, and obviously, it's moving when I'm on vacations. So we've had lots of things to happen on that September month, as we've got both a monthly close when I was away, but we also managed to have the nicest weekly closes we could have. finally something has happened, both in the stock market and bond market, gold. So we've got lots of movements out there. So things to trade on the upcoming week, as we might have some trendy positioning to happen or not. So we'll see if last week's ending, especially last Thursday and Friday, was very volatile on the market. We had risings on the VIX. We're going to talk about this. We'll see how far this can go. If we can go further or not, is really the most interesting questions in here. And we've got, as always, multiple scenarios. We're just going to try to cover up the opportunities we can take advantages of and those that really don't require your attention. So I bet we should start with the S&P 500 to have a broad sense of what the market just did, because obviously all the different major indexes in the US sector have been behaving pretty differently. Like I said, last week, I've been taking short entries on all of them just to make sure that I will broadly cover the US market cap. So I've been taking both Dow Jones, SPX, and NASDAQ as a short entry last week, and it done pretty great. But the thing is that we need to assess and manage the risk. So profit takings have been made, last week, 10% on Thursday at the bottom and 10% as well on Friday right at the bottom. So I've been sparing, and I took an additional 5% at the weekly close, which means I'm 25% off those trades. Still says I'm pretty well fucking bearish as we speak right now, as I still have 75% of those trades ongoing. So I think we're gonna go lower. The thing is that we might have some tiny retracements, so I did want to take some partial profits just to reinvest those profits at better prices. So it means rebuying some of my short leverage at the lows to re-put it on higher prices. It's just like that. It's risk management. I remain bearish in here, no problem with that, and I hardly think that we're going to go lower later this week. So in terms of timing, and we're going to have to start with this, this week is really a few catalysts, despite the GBP, and we're going to talk about this one as well. We've got production prices, and CPI core to come between Wednesday and Thursday. So these are the two major catalysts we've got for the US dollar, and obviously it all surrounds the US economy. All the other indices in the world are just fucking following the Wall Street swans. So what happens at Wall Street will decide what happens to the others. It's pure and simply this. It's a matter of dollar, 10-year yield, junk bonds. We're going to see all this. Gold pricing. It really is a big mess, and probably going to have some breakouts to occur during that week, following through the early signals we had later last week. Starting SPX. In a weekly perspective, okay, weekly chart, SPX, what we have in here, clearly bearish engulfing. Problem is that we've been breaking the previous week's high as well. So this is not the best case scenario, but what we have in here, pure and simple. First thing you can do, basic technical analysis. When you have this, you just take whatever this is, but all the overshadow of last week above the previous week's candle is a fucking strong resistance. So this is where we've got the stop loss. The market can't go there that week. If you're bearish, you can put the stop loss there, which means I'm nearly break even right now, which means this is why I choose to remain on that market and not securing more than just 25%. For the only reason that I've entered probably right here, and the stop loss is near the entry price, which means I've just been taking the money, enough money to pay for the stop loss at the above price, and it just required 25% profit taking. So now the stop is paid, which means I've got a free cash on the bear side in Wall Street, and that's all I want. I wanted to have free bearish entries, so the market can behave however the fuck it wants. I don't give a shit. All I care about is that now I have free money to the downside. If it chooses to reverse and go to the upside, I'll lose nothing. If it goes to the downside and accelerates, then I will as well put back the money in play with additional bonuses. So in the worst case scenario for Wall Street, the market just keeps on falling apart, and we've got a replicate of what happened earlier that year, which means the market just stress, and fuck it all in a single brutal bearish movement. This is what we could expect. Problem is, in terms of structures in the price, we have something suggesting this can also not be the case. So there is really two choices here. I really don't know which one's the good one. All I know is that if this is wave 1, 2 scenario, this is just wave 3, extended wave 3. But the thing is that we might have wave 4 pullback, which means what happens right now might just be a pullback to go for a higher wave 5 points, in which we'll have much better risk-reward ratio, or at least, let's say, the probabilities to see that trade working fine will be far better than this one. So I still do want to be in every bearish possible timing for the reasons you know. The market structure is really stressed, overstretched, overbought, over fucking everything you want. It's just that we are risking too much, which means anything can just blow this thing up. It's just, it just needs a reason to do it, and it can come at any time. So facing that unexpected risk, I want to be bearish in any possible timing, even if that means taking lots of stop losses in the process. I don't care. All I care is that now I have free stop loss, and I'm gonna let that trade go as far as it can. Of course, if I do see some bullish activities near those support, meaning I see exit pattern or anything like that near the 23%, obviously I'm going to secure more gains. I'm going to take some cash out regarding that risk, but you can be damn sure that any time right now I'll have bearish entries on Wall Street and keep them open. All I'll do is managing the risk according to the upcoming signals I'll have. The more I'll have bullish signals, the more I'll profit taking. But I will obviously take at least part of that trade open. I'm not going to close 100%, okay? Just in case, because anything could just go wrong without giving any pre-signal or any clue, and if something goes wrong, the market can really panic because of the fucking stupid price structure we've been putting out there, for many reasons. And I think we're going to start with this. Where the major problems are, I think, is right here. This is where I have the strongest confidence. This is where the strongest bearish signals are as well. Pretty nice fucking bearish engulfing on the weekly chart in here. And in here, we really made a fucking ugly one. This is really weird bearish engulfing, triggering the pattern of a double bearish signal. It's just a taking profit pattern. So once again, still compatible with the fact that this could just be a wave 4 pullback, which means we go there, the market's buying, probably 38% retracement, and if the market just does that, then problems are down the road, which means if the market is buying in here, we're probably going to have a wave 5 terminating the structure, which means we're going to make a new historical highs coming later on. Okay, so you need to assess this. We're 23% retracement in the Nasdaq. Nasdaq can probably digest that thing, and probably will try to go further away, meaning probably 38.2%. If we go there, this is where the big decision makes. If the bulls are still taking it over and buying the previous high, we might have a final bullish impulse lasting again 2, 3 to 4 months, no more than that, and then we'll take the big short entry out of this, which means the market might be able to terminate 2019's at the highs with a good year, but probably 2019 will be the ugliest year we've ever faced. Probably we'll head toward recession during that time period. At least we're going to build the range that will precede a bear market. So that's it. So Nasdaq is the big problem in here for the reasons you already know, and I'm going to switch right to this. We're going to cover up all those fucking assets. So we're going to have a look at the FANGIT index. Look at FANGIT. Do you really want to buy something like that? It looks really ugly. And to me, wave 4 is here. We're making wave 5, so we're building the pre-waves. Was a wave 1, 2, and we could be wave 3, which means we could have a bearish trend without problems. So the FANGIT definitely is the big problem, and this is why sorry. This is why you want to remain cautious, because that market could really well surrender all those gains. If that Fangate sector is blowing up the gains, then problems, and lots of problems, are down the road. We really are rising volume. Look at this, and we're in a weekly fucking perspective. So we look at the big fucking tech sector, the big gainers, all those who've been making the headlines recently. They're suffering right now. Volume is rising, which is the worst possible sign when volume rises and prices are not rising as well, which means money is changing hands. Remember that pattern. When you see volume rising under a resistance or on a support, and the and the volatility reducing, meaning building ranges, this is the worst case scenario. Means that the price is changing hands. And I think right now it's the smart money who's releasing the gains, taking the gains, so releasing the shares, selling them to whoever is stupid enough to buy them at that price. And generally, who the fuck is stupid enough to buy at high pricings? It's the damn retail traders. So retail traders are probably who's buying right now. So we've got both corporate making share buybacks. We have passive trading. The heaviest amount of ETF have been bought recently. So it really is like that. I mean, passive trading at the end of an economic cycle, worst possible choice you could make. So many people have been making that choice, which means lots of money is just available, free to take. So I'm obviously among the speculators who see that opportunity to take the cash of those who were stupid enough to buy the bulk thing, which means buying damn fucking ETFs, or saving accounts, all that shit. You don't want to be invested in shares right now in anything linked to corporations, because corporations might be facing 2 tough years. And if we go ahead of this, and if 2019 and 20s are going to be nasty for price in stock, why the hell would you just keep your spared accounts, your spared money in those assets that we're probably going to lose 30 to 40% in valuations? Obviously, you can either do nothing, just taking the profits and do nothing, just keep the money. It's better than losing. Or you can invest in some other places, meaning having a more aggressive approach, which means you're not just taking the money off the table, you're choosing to invest into something that can produce a slightlier but gain as well, which means you're generally good to sell your money to governments. You do into government debt. You're buying bonds instead of buying shares of stocks. This is a general move that we call the flight to safety. And this is what generally causes a huge market reversal. When huge amounts of money, I mean, institutionals are doing this all the way through in a bullish trend, which means taking partial gains, putting that money into bond market for a short period of time, or buying covers, and then they rebuy stocks again to push them at higher prices, and that's a parabolic scheme. Until we get to the point there's too much risk, so they're taking the money off the table. But the problem is that they have billions to take off the table, and we just have retail traders facing them. With the problem is that they have lots of money to sell, but fewer buyers, which is the worst case scenario, and that leads to what we already know is causing fucking market collapses. So we do have every ingredients needed for a bearish market, but we need the price to validate the structures. So far, the Fangates are showing some huge and concerning weaknesses. But if for some reasons this is just one more consolidation, if this is just wave 4, we could have wave 5 pushing an additional 10% to the upside. So you can very well have something like that, go 15% up from now. So let's say 5 to 10% addition to the current market top is very well probable. So if this is what's about to come, then you would just sell right here, where the market would just do this. So this is worst case scenario. So if you're selling the Fangates right now, it's not how it works. What it works instead is to face the problem that if it keeps on going to the downside, this is where the ugliest spot starts to come. Because this is clearly a bubble, and if this starts to burst, it can do it straight line. For a simple reason, this is because of that fucking price structure I just told you about earlier. lots of tiny retail traders who've been buying stupid prices, who've been bulk trading, buying ETF. Instead of thinking and selecting where to put the money, they decided to say, okay, you know what, everything's rising, then fuck it, I'm buying everything, which is the worst thing. Wall Street wasn't buying it all. Wall Street was rotating the money just to get out. This is the standard way to get out. You just keep the market bullish, so the stupid guys think it will remain bullish, they keep on buying, but what you do in real terms is just putting the money off the table. So whenever the price goes to resistances, you're selling that resistances regarding the demand you have in front of you, which means if you have few buyers, you are selling just a few. To avoid the market to break the supports, you just manage the range, okay, sector by sector. You're going out slightly bite by bite, and you let the stupid bulk buyer take your selling entries. That's how it is. You're selling them fucking high prices, and they're happy to do it. Obviously, they're making bad choices. It's just a matter of time before it pays off. But I think right now, as a speculator, my only job is to search for the timing. They're going to be ruined, and I'm going to take the money. So, all those shares, we could cover them up. The bearish potential is just enormous. If something like that just falls apart, Tesla probably going to have to rebuild that range to the downside. So probably we could face at least, I think, the $200 or $180 pricing will be a minimum if we go there. So once again, it's been falling apart already, but there is still a 30% delta possible on Tesla. So 30% on Tesla. Apple. If this one collapses, I mean, look at the weekly close. Worst possible case scenario. Closing at the low with an upper shadow candle. It is not good, and we're probably exiting the parabolic structure, so we'll see how it goes earlier that week. If it keeps on falling, obviously I will reinforce that thing, meaning that I will reinforce my positions to fuck up all the stupid buyers, and we could just do it straight line. Once again, the market can be, the market structure is destabilized, which means we can very well fuck the entire structure in just a few days. All we've been rising in here is because of stupid buyers. So those who've been stupidly buying in here can just be stopped out in a few weeks, not to say a few days. At least that's possible. Don't be surprised if it gets to collapse. It was expectable. Moreover, it was expected, which means I'm trading according to this. So if it happens, I'm not going to switch. I'm not going to say, oh, no, it's falling too far, so I'm profit taking, whatever shit this is. If it happens, it's part of the plan. I'll double down, which means I'm going to pile up bearish positions if the market starts to collapse. So we'll see. There's a potential that it happens, but for now we need to retrace back to that support. As long as we don't, there is still risk that this is just a trap for bears as well, and the market could just take it by the wrong side easily early that week. So it needs confirmation right now on on Apple, but if it falls apart, target is right here. So guess what? Fuck it. Minus 36% expected. Or expectable on Apple. So minus 30 on Tesla, minus 36 on Apple. Google is breaking fucking bad shape. If it goes down, minimum 12%, and we could very well make a minus 20, wouldn't necessarily be a problem. So this one, pretty much not the most interesting, but in terms of signaling, it really is showing double bearish, which means you don't generally have double bearish with lower highs on a bullish market. That just says that market isn't bullish anymore. It really is correcting at worst, at best, or is already reversing to bearish at worst. So obviously Google is interesting for a selling breakout this week. If we go there again, it needs to make a daily close below that price, not just going there. Facebook. This one's already been losing so much, but it's just showing taking profits, which means we could very well go lower and add an additional 10 to 12% loss to that game. It wouldn't necessarily be a problem, and it will be normal. Nvidia, this one is at the top and is making huge and nasty reversal. Look at the weekly candle. It's ugly as possible. If it confirms that week with another bearish candle, obviously everybody's going to follow through. Everybody's going to try to fly away from that market, which means if it goes down as well, that's support and probably going to have to go lower. Minus 37% expectable on Nvidia. Netflix is one of those who've been suffering already, like Google, but there are still lots of rooms to go. Probably 30% to expect in here, and probably even more as we could fill that gap. Amazon could very well retrace, even though Amazon, once again, great business model, what the fuck this is. It's just, it's overpriced as any other thing gets. It will retrace, but probably lower than the others, so I would just expect a 20% retracement, 20, 25, or if it goes 30 as well, like the others, I wouldn't be surprised. The thing is that, anyway, Amazon is something that we want to buy at the end of, is something I'll definitely put some money into in the next economic cycle. So if we're heading toward recession, that's great. I'll only see this as pricier things. It's just like that. I mean, it's gold prices, it's Black Friday, so if it goes minus 30%, obviously I'm going to buy some Amazon. Clearly I will. So on those prices, Amazon can be bought. Let's say a 38% retracement on the long-term retracement. If we do this, I mean, look at that. That's perfect price. You offer me $1,280. Obviously, I'm buying this on Amazon. I mean, near those prices, really gonna stick for bullish entries. Pullback bullish entries for dead key bounce. I mean, we brutally, sharply drop, fuck up all the stop losses of those who've been passively trading those prices and made the worst possible decision. We just flush them out, but they won't go entirely out. They'll just probably take 50% off the table and say, no matter what, it's going to go higher afterwards. Remember what happens when we go to the dead kid bounce. The market is dead, everybody knows it, but the retail traders think it's still going to go higher and to the moon. They're basically going to take the monthly chart, say, okay, we've done this. This is just a pullback. We've done that already in the past, and every time afterward, the market recovered. So they basically, once we've done this, going to think that the market will go there afterwards. I mean, Bitcoin to the moon. $100,000, obviously going to happen for sure. I can remain all those bullshit I've been reading back then. It is exactly the same. So it's not going to go up forever, obviously not, and we clearly have a timing to set to short this thing. Same thing goes for Boeing. I mean, Boeing goes there, everybody's going to buy it, thinking to the moon forever, so this will just be a dead cat bounce pullback. This is where we're going to make the the much more solid positioning. So this is just speculation. I just want to take the money out of the stupid guys who've been buying ETFs. This is where I take their money, and then I'm going to just flush the rest of their money during the crashing patterns that will probably trigger afterwards. But step by step, if we do have that collapse, we know the next step is dead cat bounce, so you don't want to be selling a dead cat bounce. You let them rebuy that market. You do buy some few assets like probably Amazon. And then when the market finished the dead cat bounce, you don't want to miss the shot. This is where you want to put the big short positions to profit from a potential crashing market. General Electrics, we're going to have to finish on this one. A totally opposite scenario in here, obviously. When the others have been suffering, who's been gaining? General Electric. So we had a nice week triggering, and I shared that chart with you guys yesterday. Double bullish signals been going through General Electrics on a weekly chart signaling. Problem is that this is a double taking profit pattern, so this is not the best case scenario, and we're in a squeezing pattern moreover. So this doesn't mean the market is bottoming just right now, just says that the market could do it. If it does, then you still want to be patient, meaning that we could very well fuck up that low in a 2 to 3 month perspective. Just like I said, I think this market is just behaving the opposite of the stock market, which means it's clearly going to be a cover whenever the market will choose, or if the market chooses to collapse. So, as I said, as Wall Street could still have the possibility to make a higher high, slightly higher high, and in the latest pullback will just be wave 4, then in that perspective, then this is just a wave 4 as well. We could make a wave 5 and go break that taking profit, or at least try to go slightly lower. So you don't want to be fully invested, fully leveraged right now in General Electrics. It's just regarding that double taking profit, I'm ready to buy any pullback we could have in the weekly chart time frame, in intraday time frame. So I'll probably say that in 2 hours. So if, for example, we have a market pullback in 2 hours, showing some bullish signals, I'm probably going to have to take those double bullish. But for now, we have nothing. So it's just waiting to have double bullish signals on the pullback. Probably that price is going to be interesting. For now, I can see the bullish breakout. If it goes validated, no problem. I'm already buying that stock. So if it goes up, that's a good sign. But if it fails that breakout, it means just one thing, that we're ranging, and that's what I would like to see. If the market goes there, fails, and retrace, I want to catch the retracement, meaning range activity, you're buying at the lows. You're not buying at the highs, okay? But I'm not going to sell. I think if we build a range, it's going to be bullish range. So if we go there, I'm not selling. I'm just going to buy if we go to the blue area. And if we break the red area, that's good. I still have speculative positions in that market. But in order to step in with further positioning, meaning more aggressive approach, you need to have real price confirmation. And for that, you need to have the price ranging first and showing some breakout patterns afterwards. So that's it for individual stocks. So just to sum up informations, the broad market is in that bad shape, but the Nasdaq is showing some weird signs of potential, really huge weaknesses, because most of its biggest component could just lose between 15 to 20 or even 30 to 35%. So I think if a collapse is triggering, it will be because of all those ETF stupid buyings and things like that. Okay, if it happens, you don't want to be surprised. It was part of the plan. Now we're going to go over the risk sector. I think all the correlated risks we have, the quarter we've been watching closely. We do have the junk bonds, the VIX. We do have the yen and the gold used as covering, used to cover eventual problems that could have the stock market. If the money is flushing out of stock market, obviously has to go somewhere. I mean, investor doesn't take cash or can take part of amount of the equity amount in cash, but generally they have to invest somewhere. And what I'm trying to figure out is what that somewhere could be. And it pure and simply is those I've been forecasting to be, which is our damn quarter. So I'm going to just load that chart. It's going to save us some time. So it's the quartet. Sorry, not the quarter. It's the quartet. Okay. So here we go. The quartet we have in here, same as always. We've got what is in here is, oh damn it. I don't want this to be US 2 years. Yes, but the repo market isn't quoting anymore. TVC is not offering that contract anymore, but we definitely set it ourselves above 2% right now. So back in that market, I said whenever the repo market is going to be above 2%, we're going to have a lack of short-term liquidity. We mean speculators will pull out. We'll have less speculators, which means it's going to be easier for the long-term sellers to just it's going to be worse for the long-term sellers to find buyers on the opposite side, which means we're going to switch products from hand to hand, and whenever we'll reach the tipping point, it's going to get ugly. So in terms of bond market, which means short-term bond market especially, because everybody is talking about the 10-year yield. Fuck it, that's not where the problem is. Yes, the 10-year yield can attract some money, which means some investor can switch to flight to quality and go to the bond market instead of the stock market. That's an option to just purge the money out of stock market. But the real problem is the short-term lendings, the repo market we've been talking about, which is linked to the 10-year as well. When the 10-year is rising, the repo market has been rising as well. So right now, repo market is approximately trading at 2.20, which is a big problem. Meaning to make gains, short-term gains, speculators have to lend money with a 2-yielded percentage, which is a problem. It's too big for speculation, which means you have to increase the amount of risk you're taking. You're taking more risk, which means more reward. And the rewards are not there. As you can see, the pricings are not rising. So price is not rising anymore. Risk is increasing, and risk is more expensive as well. So this is the dead cross in here. the real dead cross, not the fucking moving average dead crossing that is just bullshit. It's just that what we have in here is really the market is trapped between more expensive risk by the yields increasing and less return. So this is the worst case scenario for the bullish market. Generally, this is how it ends. We have euphoria, we've got problems, and we've got more expensive risk taking, which is problematic. Second market we had to watch for is the Jong bond market. Look at this. This is collapsing. The Jong bond market is already back to panic level trigger. It doesn't mean we're panicking. It means that we're back to probable panic triggers. So this is important. And I think this is what highlights the really important timing we're currently on right now. Last week was a warning. Really a big warning. All the signs are red. The thing is that before we switch to black, there still need some confirmations. We need the junk bonds to keep on being sold. And if that's the case, then the worst is ahead in terms of risk, meaning that the entire bond market sector is going to be under heavy pressures. Long-term yield rising and junk bonds overselling, which will be huge problems ahead, switching to panic mode. Second problem, gold and precious metals. What we have in here, they do everything to hold the gold, not breaking the resistances. The moment the gold breaks its resistance, it's end of the game. This is all about that. If we do break that support, and if we do break that resistances, it's game over. It means the money will obviously go there. It means corporate bonds is gonna be the worst investment you could have made, which means investing into corporations will be problematic, which means that probably the Russell will fall apart and collapse because the small cap will just suffer from lack of available cash and fewer profits. I mean, if profits are just dropping, profits are reducing, and cash flow is negative, we have problems. It means that lots of companies will just have to foreclose. And if that happens, that's a problem. That says the economy has been overrunning, and if the small caps suffer, it means the entire market cap will collapse afterwards. It's always a pre-signal, and what we had last week is just showing that the small caps are suffering, and that's not a good sign. Then we terminate that tour with the VIX as well, showing huge signs of heavy covers, which means the market is fearing something and we'll have problems ahead, even though the structure of the bullish market, stock market, remains bullish. But we do have that big problem, which means the risk is not following, which means we make higher pricings on the indexes, but the VIX isn't showing same things, which means we're already building. This was a wave 4, and I clearly stated this. Next step is terminating wave 5, and we're going to have the market collapse. So we're building the rising volatility system, which is the worst case scenario. Risk is rising as prices do as well. Problems are ahead. This cannot terminate well, and this will bring volatility back in the market anyway. But it can be bullish volatility as well, and you need to be really aware about that. You can have a rising VIX with a rising stock market. It just means the volatility, the bid-ask spread, not the bid-ask spread, but the put to call ratio is spreading a lot, and this is not this will be the worst case scenario. It will be just bringing panic in the market, either to the bull side or the bear side. I mean, the market, if the market just goes surging to the bullish side, means that the end will be even worse afterwards because we'll take even more risk. Which is not necessary at that point. We should just surrender the gains, flush the nasty bond market we've been creating with the QE. It will be making the markets in a better shape. Actually, it's just reshaping things to a better shape to go ahead for a new economic cycle and things like that. It means just flushing the mistakes and the errors and just start it over again. That's how it goes. The market never stops. It's just refreshing, breathing in, breathing out, and starting all over again. So I don't think that if we're collapsing, it's going to be the end of the world. It's just we're going to have a market correction. That's how it goes. This is what we call bear market. It's nothing close like being a perma-bearish fucking trader. It's just right now is the time to search for selling entries. That's it. Point. We don't have to overspeak this. Those who think I'm a perma-bearish, then think it that way. I don't give a shit. Or no, I'm just doing my job and no more than that. So we've been breaking resistances in the volatility. That was to be expected. Now it's on the charts. The fact that we've done that suggests that worst case scenario, we're already building the bullish side. Best case scenario for the bulls means that we've just made a wave 4. We can retrace, probably not making a new low, meaning just retracing in here. And we're going to have 2 sets of higher high and higher lows, which means afterwards volatility might be surging. But this is cycles, so look at cycles and look how long they take. A cycle can take up to 24 bars, which means 5 weeks of trading. And 5 weeks of trading can lead us too far beyond right now, and we can say 5 to 10 weeks. So we still have a possible 5 to 10 weeks, let's say, spread before nasty things have to be at play. So we're going to be forced to have volatility at some point. It's just we're building what's leading us to that volatility as we speak. So you need to be searching for bearish entries more than ever, but certainly not leverage bearish entries. And moreover, you still want to handle the risk, which means you want to pay for the stop losses as soon as you can, just like I did. And you just want to let go with the rest of those positions, hoping the market could just collapse. And if it isn't, you're going to take the stop losses, free stop losses, and try again the next time, probably in a 5 to 10 weeks perspective from now. So it all says the gold could go lower. Sorry, god damn it. You don't want to change that. Could you switch me back? Alright. So we're returning to the previous chart. I'm going to have a look at... Yes, we're going to leave page. We're going to go to the gold. Have a look at the charts itself. So what it looks like is great. I think we terminated a very nice structure in here. To me, it really looks like a complex retracement, really complex. I mean, look at the time we took to make the bullish impulse. Basically took us that amount of time. So it took us 3 times more to build that corrective waves. But the structure it has really remains corrective. So to me, clearly bullish impulse in here, 1, 2, 3, 4, 5, clearly visible on the chart. But then noise. W, 2 waves down, 2 waves up, X, 2 waves down, terminate I. Alright, so we've been doing this. Complex corrective waves. No matter what, it remains corrective waves. As long as we don't break the X point, there is no validation. So we could still try to build the I points. So 1, 2, 1, 2, could be just 1 and 2 to make. So if the gold is retracing one more time, no problem. All we care about is not to break that low. So if it goes there, you don't want to be panicking and shorts and exiting the long position on the gold, whatever shit this is. Anytime we go into that damn blue area, this is where you want to pile up gains. This is where you want to buy. As long as we don't break the resistance, you can't go leverage. Which means if you already maximum leverage, you just do fucking nothing. You put the black box in here, and as long as we're in the damn black box, there's nothing you care about. So if you cannot manage to handle the stressing of not knowing, then use the black box. This is the point in here. If you can't, if not knowing is too stressful for you, then put the black box, put 2 alerts at the sides of the black box, and you just wait in between. But don't have a look at that chart. Looking at the candles is just going to make you make stupid decisions. Sorry about that. Kind of a sick as well. I mean, it's like I've been sick entire summer. I mean, it's crazy, and we're heading into winter and probably the same thing expecting. So anyway, gold and silver under pressure at the early beginning trading of that year, of that week. This doesn't sound like a bullish structure to me, as we're making 1, 2 waves to the upside. So it doesn't look like the market is ready yet for some bullishness. So I could expect that we could just try to fuck up some bears in here. fuck up some bulls. Those who've been buying in here will be stop break even. We could try just to fuck up their stop losses, but I don't think we're going to go much further than that. So you just take usual retracement levels. And as you can see, we've been facing 61. We could very well face 76.4, and that wouldn't necessarily be the end of the world. So if it happens, be prepared for it. Where the problems are is if we make candle closes below those lows, this is where this is going to be problematic. But if we go there, to me, I will even consider making some tiny reinforcements. It will be really, really nice prices to do it. But for now, we still need for price validation. So in my perspective, interesting to buy upon breakout, uninteresting to do nothing. So you saw it as well as a market cap that I'd like to sell, but I said I will wait for a 2-hour pullback signal, which means we're breaking bullishes. I'll wait for the market to make wave 1. I'll wait for the wave 2 pullback, and the bearish signals probably showing in here will be interesting to me to get into shorting the wave 3. That may come afterwards if I'm right. So it's too late to go into wave 1 territory at that point, so I'm just basically waiting for that market to terminate it, retrace, and I'll get back in. Euro dollar, this one I don't care. GBP USD, I really care about this one. A beautiful structure that we have in here. Market rising, market really well rising. It's hard to say how that market behaves because this really looks like a two-wave impulse, like A, B, C. Okay, and this clearly looks like a range as well. So I would say 1, 2, 3, 4 at play, and we've been retracing perfectly into wave 1 resistances. Remember, this is a tip I've been sharing you again earlier. I've been sharing you earlier, and I'm going to do it again today, just as a reminder. When you do make this, I mean, you know, leading diagonals or ending diagonals. The only difference between the standard trendy waves is that they do plot 5 waves, but they don't put trend in those 5 sub counts, which means the bullish impulses are ranges as well. So the overall thing looks like a range, but it's a bullish range that shows huge bullishness to expect afterwards. So if I'm right, generally wave 4 retraces into wave 1 territory, so you don't have overlapping of wave 1 4. Wave 4 enters wave 1, and it's generally searching for wave 1 previous resistances. So okay, we've found a resistance in here in wave 1. We also found another one back there. And as you can see, the market has just been retracing exactly to that point, and it's been buying there. So really good sign of a potential leading diagonal to build out there, as we've been making this in 2 sub-wave counts and failing that breakdown. Really a great sign to me that this market is bullish. I've been ready to rise this to 3 on 5. So I'm rising, ready to put leverage on that market, as this is 1, 2, 3. Wave 3 is bigger than wave 1, so wave 5 probably is going to be bigger than wave 3. And I can expect the market to go testing all that set of resistances. So we've got lots of things to trigger, lots of targets to head forward for. And we're going to just basically switch for 127%. Now that we have the extensions, we can do the job. Okay, so I can forecast the market to do just this. Bottom of wave 2, top of wave 3, bottom of wave 4, and we're seeking 127. So this is probably that set of retracement that we are seeking for. I'm going to use the retracement to just see if we have a cluster emerging out there. Okay, cluster will be around 50% retracement. So I'd say this place in here is interesting. This set of resistance clearly is where you want a profit taking as a bull, which means it's not going to be a selling entry. It's just going to be a taking profit area to take probably 75% profit or 50% profit. As this is a leading diagonal, we could have just a very tiny pullback on wave 2, which means probably 50% profit taking in here is more than enough, and no more than that. Sorry about that. We're double bullish. Okay, blue triangle, bullish cycle, bullish okay on momentum. It is the weakest potential signal as it's just coming from the oscillator. But anyway, it remains a bullish signal. So the daily chart is already confirmed that we can buy anything that we have pullbacking into our chart time frame in the next few days and hours. So I'm probably going to have to rebuy this if we do have some pullback on that support or even this one. Any prices available in here is something I will buy on that market. Okay, so searching for those pullbacks, and if any 2-hour bullish signal shows up in here, I'll definitely get to buy them. EURJPY, hell of a scenario, and as you can see, fucking hell. I know lots of people, lots of guys have been doubting that scenario. Some have been nearly insulting me of remaining a seller in a market that was rising. So as I said, we'll talk about that when the story ends, and it's still not ending right now. As you can see, stop losses haven't been triggered, and even worse than that, I'm turning to positive on that market. So all I want to say right now, it's not a won battle, far from this, really, really far from this. But I'm not that kind of guy who come at those who've been bullshitting me. I mean, basically, I'm not that kind of guy, but sometimes I am. So fuck you guys, those who've been insulting me, telling me I'm going to take the hugest loss, the biggest loss of my life because I was stupidly remaining bearish on the market that was going bullish. All I say, and basically said, is what I've been standing for since the first day. I know the market is behaving on the opposite. I know the market is chasing for my stop losses. All I was doing in here was managing the risks and see if it's worth to trigger the stop loss or not. I decided not to do it because I had what looks like a range in front of me, and I said we could just be chasing stop losses in a range, and as far as I can handle this, I will take the risk. So I've been taking that risk. We'll see if the risk will pay. But if I'm right, and if this was just a bull trap, a stop hunting trap, we're going to wrong foot the bulls, which means we're going to go low and we're going to do it fast with both a bearish euro and a huge bullish yen. So now I'm just waiting for the yen to show some strength. If it does, and it's an if, huge problems are ahead for those who've been buying EURJPY because it's going to be going worse and it's going to be doing it fast. So it's still way too early to consider this a won battle, but if the yen wakes up for some reasons, Euro-yen is going to accelerate. Pretty much like it's done back then, vertical drop down because Euro remains consolidating right now and yen could be surging. So Euro-yen definitely is kind of the kind of market that can attract some attention and get some traction to the downside if it keeps on going this way. So the momentum is heavily pressured. Okay, which means we're overselling. It gives us two options. We're nearly overselling. If we stop there and if the bulls take it over, I will exit for pure and simple reasons. It will be too risky to remain in because this way we could face a potentially bullish market. Okay, it will be what we call a hidden bullish divergence. Last time we've got there to retrace this. This time we've spent far more energy to go as low. So if we stop here, problems ahead for EURJPY. If we keep on falling apart in here, then that's the best case scenario. And I'll turn what was a bad loss. It really was a potential big loss. Probably the biggest loss I would take this year. If I had to take this one, it would have been a 7 to 8% loss. Big loss, but once again, loss out of gains. So I just surrendered part of my previous gains. But if it turns out to be a gain, then really, 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 I'll be laughing at those who really insulted me back then. So anyway, I'm not here for them. I don't really care about those who insult. All I care is to make the gain, as once again, all I forecast for is for the price to reach out my targets, because when it does, I take huge amounts of money. When it doesn't, I take tiny losses, and that's all that makes my job. The rest is for the stupid guys to talk for. So the yen could just show some strength. Same goes for NZD yen. It's been surging to the it's been falling apart. Pretty brutal, and I'm going to head toward the selling breakout final reinforcements to go fully leveraged on that market if we go there and make a daily candle close. USD/JPY as well, it's been reversing pretty brutally. So right in here, pursing line, the market goes there, is failing the day right after. So the market is now testing the 61% retracement. We'll see if it stands or not. It really is a game changer because we do take this, okay, top from low. We've been retracing 61 back then. We try to rise above it, not reaching to 76.4, and we're pullbacking 61.8. It really gives us two options. Either we find a support in here, we're going to surge for 76.4, but not necessarily going to be because of the yen. It's just, remember, these are ratios when we do trade in forex, meaning that the US dollar is as important as the yen is in that cross. And I think in that perspective of more bullishness, it's going to be because of the dollar and not because of the yen. We could have bullish yen and bullish dollar, simply a much more bullish dollar in a short-term perspective, meaning for just a couple or say 10 weeks ahead, we could have some bullishness in the dollar over strengthening the yen. And if that's what's about to happen, then no problem, that's part of the plan. So if USD yen is going there, obviously I'll take a short entry. But for now, I remain very low leverage on that market. Stop loss hasn't been triggered yet. It's just I'm waiting to see the price confirming and see where this happens. It can happen in that price area. I just don't want it to happen higher than that. If the market makes multiple candle closes above 115.3, means the scenario will reach out invalidation. So this is not a market stop loss. Let's set things straight. It really is an invalidation to me. If the market rises above this, I'll consider invalidation and trigger manual stop losses. If they don't, and if they fail in that price area, or even worse, if we keep on going to the downside here, obviously I'm going to follow through. The confirmations will come there. So if we go there, there will be selling breakout entries to go for some more bearishness. USD CAD is a really interesting thing. I just forgot to talk about this for the French users. So we'll see about that. Thanks to Rizes, it's a French guy, so because he's been pulling that scenario out in that wave count, so I've been taking it from him. So obviously, I'm giving him the credits of using that scenario. I think it's just a great analysis. So I'm going to share that with you as well. But really, the ID, the initial ID, comes from someone else. So credits goes to those to really the one who had the ID in the first place. So what it says is basically, yes, we're terminating ABC correction in here. Clearly see those two impulses, the in-between range. So after an ABC, we generally retrace. We generally recover the bullish trend. So USD CAD is bullish, clearly is, meaning the dollar is appreciating, is rising faster than the Canadian dollar in a long-term perspective, in a weekly, monthly chart perspective. And we're searching for a... So this is a weekly scenario, okay? Weekly scenario that says, sorry about that. In that scenario, we're searching for bullish entries, okay? Bullish entries on a weekly bullish context, okay? Context is we terminated that consolidation. The momentum has been oversold, so we're searching for bullish entries. All we'll look forward for is the daily chart confirmation, so the daily chart signal. We had the taking profit pattern on momentum, but way more, but not enough, as we couldn't find a confirmation from sine wave. But on the opposite, what we had is now the market tried to break down and is about to reverse, which means we've been trapping some bears in here. And if we do break a resistance, I'll trigger a freaking first entry. It's going to be a breakout entry, so once again, you know the drill. When it's a breakout entry, this is low leveraged because you have to pay for a large stop loss. It means the stop loss will be set at the lows, okay? I'm going to have to make a stop loss in here, which means the profit taking is going to be made in here to take 50% off the table and pay for the stop losses, which means if it goes there and trigger the breakout trade, we're going to have to profit taking 50% in here. To pay for the stop loss, let the market retrace range, and then we'll forecast more bullishness whenever we go ahead of target number one. But first, this is many steps ahead from now, which means when we do this, we might want to just profit taking in here, wait and see, and when the market goes up again, go for further. But it's too many ifs one after the other, so you just wait step by step to see that potential scenario triggering first, confirming, and then reaching the target. And then we'll have new things to talk about, we'll have new charts, informations. So I'd rather like not to put too many steps ahead on that scenario, just waiting for that C point to validate determination. If we stop here and if we fail here, we could very well retrace back to the support. In that case, when you search for an 100% to 127% extension of A wave, which means C wave is not nearly terminated right now, unless it manages to break out the trade, to trigger the breakout trade. As long as we remain making lower lows and lower highs, we can still keep on falling to heading to the next bearish supports, bullish supports. USD CNH is a scenario that I need to cancel. Probably I'm going to have to re-enter again, or I need to take some partial losses. I need to see how leveraged I am on this one, as we never managed to trigger the confirmation signal, and the market is trying to reverse. So we're in a range. Problem is that, as usual, when you're in a range, you don't know what to do. You don't know what the price will do. You just want to trade risk-reward ratios. So I think in the USD CNH, I might have those price, which means I'm negative right now, but I'm not end of the world kind of bearish, kind of negative, and because I've not been using leverage. Once again, same reasons. When you do speculate, you just wait for the price to confirm to go leveraged. So right now I remain low leverage in here, never managed to confirm the trade. So either the market is reversing in here, so it definitely needs an alert in here. But if the market keeps on rising, and if the dollar is researched earlier that week, probably going to have to look for an extension, which is going to be that area near and above $7. Sorry, seven. Okay, all right, you got it. So the thing is that obviously the stop loss will be set above those price. So that bearish entries I've made right here, if the price goes there, obviously going to have to be a speculative loss. And I will take a partial loss if necessary, but I think I can handle this. How much is this? Yes, definitely can handle this. So I'm going to stay there for now, holding the USD CNH thing and waiting for this to eventually trigger for more bearishness. USD Amexen as well, it could have and could suffer some ranging in here because of a strong dollar, but anyway, the Amexen remains strong as well right now, which means we could just range in here waiting for wave 3 to occur. So as long as it's the case, and that's what's at play, I'm just waiting for that range to build up, waiting for a potential double bearish to reinforce, and then I'll get to wait for the bearish breakdown of that price area to trigger a bearish breakout reinforcement, meaning doubling the position sizing, lowering the stop losses, and that will be good. Okay, and AUDNZD, we're going to terminate on this one. Hell of a nice week for this one, as we managed to make a bullish engulfing with opening at the low and closing at the high, so that's great. I want to see if the market manages to confirm that week, as we're pretty much in a messy range, so that bullish engulfing is a good sign, but it could very well be invalidated as well. So as for now, as long as we remain above the previous week's low, which is there, if we manage to stay above those prices, I think we're good. Doesn't say we're won, but all it says that we're good. And I'd like to see that. So the market may deeply retrace last week's trading, can go there, but I would like to see the market anyway maintaining bite by bite a bullish demand, pushing the prices to slightly higher levels. Obviously you can see the Bollinger Bands are totally flat, but if we could manage to just narrow the to expand the short-term volatility. So find some volatility to the bull side, to reach out for that area, that will be really a freaking great sign that this market wants to hold the gains. And we'll have retraced 61% of the previous impulse, which is a deep retracement, but showing that we'll have a very strong wave 5 upcoming afterwards. So waiting for this. So in terms of forex, this week's deal is trying to figure out if the dollar is bullish or if that bearish is just that bearish signal is just a trap. If you have a look at this, this is clear double bearish signal, just waiting for the red triangle to confirm. So if the market is just falling again on the dollar, you really want to be bearish dollar. If the yen on the opposite is triggering the double bullish, then as well this will be a good, really good sign. I think the market has everything it needs in here to switch to bullish cycles. After that, taking profit, I can beg you that the market is probably going to trigger a bullish pattern in here. So I'm just definitely waiting for sine wave to detect this bullish activity. So we've been covering nearly everything, I think, right now. So bond market is overstretched, but I think this is not yet the end of the world. We could still have slightly higher 10-year yieldings, as we've been highlighting. In a 2-hour chart, the breakout is showing us potential to reach out to 3.40 in terms of 10-year yielding. So we could very well be there, not necessarily being the end of the world. The market is talking about the 10-year yield. This is what's been making the headlines recently. But let's set things real straight. The market doesn't give a shit about the 10-year yieldings. This is not what the problem is. This is short-term problems because we care about the 10-year yields at some point, but I think it's not just right now. What we care about is the problem that we're lacking of short-term liquidity, which means the volumes will drop, and when volume drops below resistances, after the volume has been picking up on those resistances, which means reaching resistances, volume picking up, and then volume lowering, it's generally either triggering false bullish breakout or really strong bearish breakdowns. So we'll see which one the market will take, but you need to be ready for potential short-term bullish breakout attempts that will probably fail and be a dead on arrival. So we'll see about that. So this week's really big game is about the dollar. You know that we have catalysts about those markets. So I'll try to look out for the speculative entries I have on USD, CNH, and MXN to eventually reinforce those if the dollar was to be disappointing. If the dollar shows some strength, then I might have to eventually lower a bit the leverage, the speculative entries in here, just to be able to take some more at higher prices in a couple weeks from now. So that's it. I'm going to take the questions right now. If you left some, great, not that much question. So 37, okay. Probably I can make a false pronunciation in here. So things here highlight for me. Have some kind of premium subscription, like to blindly follow you, please. God damn it! I hope you will never do that to anyone with anyone else. I mean, what I'm trying to teach you out here is that all those premium subscription bullshit thing are just dream catchers. They're here to leave out your money. They're not making gains. They're just making you believe they do. For most of them, there are a few examples, a few counter examples, but most of the time, those who will sell you premiums are not traders themselves, or their income is not related to trading, which means it's a problem. Guys are trying to sell you signals, but they don't live from those old signals. So what the fuck is the point? You're just being bullshitted. So yes, I obviously don't want you to do this, and all I try to do is to drag you away from this. There will never ever be fucking pro premium subscription thing with me. It will never happen, never ever. So and you will never ever be able to blindly follow me. I hate the idea of signal selling. Some people do it well. I won't tell the opposite. Most of people don't do it well. And anyway, my position in here is that I'm fully against this. So I respect those who do it, as long as they fully do it. Those who bullshitly selling bull signal to make money out of you, I fucking hate those guys, and I do anything I can to drag you away from those bullshitters. But they're obviously there. You have to know it. And as I said, if what you're looking for is simple signal following, even if it's a price, if it has a price to pay for, then you're definitely in the wrong place. I'm not here to teach you. I'm not here to feed you guys, but more likely to teach you how to feed yourselves. And you certainly don't want to follow me blindly. As usual, I have to put that at risk assessment. I am the heaviest amount of risk that a trader can take. There's obviously a few examples that can be riskier than me, but I'm among the top riskier traders you can find sharing their knowledge in internet. So regarding that amount of risk, not everyone will be able to handle this. Okay, so my perspective in here is just to be truly honest with you guys. I know most of you are low capitalized, which is a problem. This is a risk in the market when you have few available capital than the others. Meaning anything below 15K is not enough to start trading decently. So this is a risk. That doesn't say you can't do it. It says that in order to make enough money out of that tiny amount of money, you're gonna have to use leveraging. And leveraging can be done in two ways, either by using market position leverage. You're going to use sized position, even if you don't have the margin to hold those positions, which is going to cause a single problem that someday something will go wrong and you're going to be margin called, so you're going to lose it all, which is the worst case scenario. So obviously that's not even an option to use position size leverage. But there is another leverage, which is to leverage the gains. You can, as I said, use sizing, position sizing leverage, or you can use market aggressivity risk. You're taking more risk into your positions, which is the only solution in which you have a chance to succeed. So it is just that you have no choice. If you are low capitalized, then you're just, the rope is already around your neck, you have no choice. You're going to try to survive and you're going to have to take risks. This is how it goes. So I'm teaching you how to handle those risks. This is what I do here. If you have 200Ks on your account, then fuck it. Do some trend trading. Don't take risks. That's not necessary. Okay? And you certainly don't want to take risks with 200Ks. That's not necessary. But if you do have what I do, I mean, I'm trading each and every year with 50K, and as I do this, I don't want to take too much risks. If you do, that's up to you, but I'm not backing you on this, all right? Let's just set things real straight in here. I've been fully honest with you. I know what I'm doing. I know what I can be good at teaching you to do. I know what I'm good for. Those who just don't follow the rules will just fall into any possible traps, and there are many of those when you do try trading. So that being said, we're going to stop on those nice words. I just want to thank you for one final thing that I just kind of spotted yesterday. I'm not the kind of statistic guy who's just following the things each and every day, trying to figure out how many subscribers I have or whatever shit this is. I just came across this number just this morning and I saw we were crossing 9,000. So really, thank you guys. Really, thank you. It's just, I'm doing this for free. I'm not trying to sell you my stuff in every show, trying to make commercials, inviting you to buy the indicators or shit like that. Just trying to teach you the things I've been learning hard the latest few years. And I really thank you, because this is what I care the most. For you to be happy with it. To having consistent statistics. I mean, this is, as you can see, it's ups and down because there are days I'm not showing videos. But as you can see, the numbers remain static. And this is something I really like. It means that you're here and you're coming back for more. And this is what I like. So thank you for just doing what you're already doing. So I cannot say more than just keep doing the way you do, and I will as well. And of course, if something changes, just tell me. I mean, I'm here to listen for your demands as well. So if you got suggestions, I'm really open for this. So I strongly want to develop the US community because, as you can see, the things are most likely watched by French users. You guys are far less users, so I'll be pleased to have more of English users. So if there's just one thing you can do for me, and I'm not begging for clicks, I hate that, I'm not a click whore. It's just, if you want to thank me, I don't want you to send some stupid cash to my tip jar or whatever shit those YouTube traders are doing. There are no tip jars for pro indicators. I'm not needing you for your money. So if you want to help, you can just, share this, talk to this about other people. There is no better promotion for a channel that somebody just promoting it because it feels great about it. So if you feel great about the job I'm doing and feeling great about the way you want to share it with two others, that's the best way you can thank me for this. And I cannot be thankful enough for this. That being said, thank you for listening all this through. It's been more than 1 hour long today, but obviously as I was getting back from vacations, we had to talk about lots of things and covering all asset classes today. So now that's this been said, see you tomorrow, guys. Bye-bye.